Have you heard the news that the White House is now saying 88% of Social Security beneficiaries will no longer pay taxes on their benefits? A brand new memo outlines a tax deduction that could significantly reduce the burden for millions of seniors starting in 2025. At the center of this change is a $6,000 tax deduction specifically for individuals aged 65 and older. It sounds like a massive win for seniors, but before we celebrate, let's dig into the full picture. Because while this tax break may sound like the end of Social Security taxes, the reality is much more complex. In this video, we'll break down exactly what this new tax policy includes, who it impacts, how it works, and why it's only temporary. We'll clarify what the White House memo actually says, and we'll also bust a few common myths that could leave many people misinformed. If you're receiving Social Security, nearing retirement, or helping someone manage their benefits, you need to understand how this change could affect your finances in the next 4 years. Before we begin, please like this video, subscribe to Social Security Post, and drop your questions in the comments below. I'd love to hear from you. Do you believe Social Security should be taxed at all? Let's talk about it. The memo from the White House Council of Economic Advisors introduces a new provision in a broader reconciliation bill that would grant a $6,000 tax deduction to seniors aged 65 and older. According to their estimate, this deduction will reduce tax liabilities for the majority of beneficiaries so significantly that 88% of them may no longer owe taxes on their Social Security benefits. On the surface, this sounds like a historic step toward easing the financial burden on older Americans who live on fixed incomes. But like most government policies, the devil is in the details. Despite the hopeful language used in the memo, the policy does not repeal the taxation of Social Security benefits. Instead, it provides an additional deduction that lowers the amount of income subject to tax. If a beneficiary's taxable income drops below the threshold due to this deduction, they may indeed owe nothing in taxes, but that's not guaranteed for everyone. This distinction is important because it means the law allowing Social Security taxation is still in effect. It just impacts fewer people under this temporary change. So, while the numbers look great on paper, it's crucial to understand this is not the same as eliminating Social Security taxes entirely. At the heart of this policy is a simple concept. Seniors aged 65 or older will receive an additional $6,000 deduction on their federal income taxes starting in 2025. This is on top of the standard deduction that all taxpayers already receive. For example, a single senior taxpayer would go from claiming around $15,000 in deductions to about $21,000, while a married couple filing jointly could increase their deduction from $30,000 to $42,000. This additional deduction could make a meaningful difference for those whose incomes are close to the threshold for Social Security taxation. This deduction is targeted at Americans with modest to moderate retirement income. Individuals must have annual income under $75,000, and couples must earn less than $150,000 to qualify for the full benefit. Since the average Social Security recipient receives about $2,000 a month, or $24,000 annually, millions of people fall comfortably within these limits. By reducing taxable income, this deduction can push many seniors below the threshold at which their benefits would normally be taxed, thereby eliminating their federal tax liability on Social Security income for that year. However, as we'll see in the next section, it won't help everyone equally. One of the most common questions being asked is whether this new deduction truly means zero taxes for most seniors. The answer depends on your full financial picture. Right now, Social Security becomes taxable when your combined income exceeds certain thresholds: $25,000 for individuals and $32,000 for married couples. Combined income includes adjusted gross income, non-taxable interest, and half of your Social Security benefits. If you exceed these thresholds, a portion of your benefits becomes taxable, up to 85%. So how does the new deduction help? If your income is close to the threshold, the $6,000 deduction could push you below it, meaning none of your Social Security will be taxed. That's the reasoning behind the White House's 88% claim. However, if you have additional income sources, such as pension payments, IRA withdrawals, or even part-time work, your income might still be high enough that some portion of your benefits remains taxable. In short, the deduction is very helpful, but it's not a universal solution. Each household's benefit will vary based on income level, tax filing status, and other deductions or credits. Now let's talk about something very important that hasn't received enough attention. This deduction is only temporary. It's currently authorized for 4 years only, 2025, 2026, 2027, and 2028. After that, the deduction is scheduled to expire unless Congress passes new legislation to extend it. That means the tax savings you may experience during those 4 years could vanish starting in 2029, returning you to the same tax situation you're in today. This creates a lot of uncertainty for seniors who are trying to plan their retirement finances. If you count on the deduction and structure your income around it, you may face a sudden tax spike in 2029. It's also worth noting that this deduction doesn't apply automatically. It must be properly claimed on your tax return. And it only applies to those whose incomes remain under the specified limits. So while this deduction is a generous short-term benefit, it's not a long-term fix, and it doesn't address the underlying issue of taxing Social Security benefits in the first place. It's more of a temporary relief patch, not a permanent solution. There are several misunderstandings circulating online and in media reports that need to be addressed. First and foremost, this change does not repeal the taxation of Social Security. Many people hear headlines like, "No more taxes on benefits," and assume the law has been permanently changed, but that's simply not true. The rule allowing Social Security to be taxed, originally enacted in the 1980s, remains in place. What's being offered here is just an extra deduction that reduces the amount of income subject to tax. Second, it's important to separate this deduction from payroll taxes. Payroll taxes are the contributions taken from your paycheck while you're working to fund Social Security and Medicare. Those are not affected at all by this policy. This change only impacts the income taxes you pay on your benefits after you retire. And finally, this deduction isn't automatically applied. You need to file taxes and meet the income and age requirements to receive it. Seniors who don't file returns or who rely on someone else to prepare their taxes will need to make sure this deduction is actually claimed, or they could miss out entirely. Understanding these distinctions is critical to making informed financial decisions. As promising as the new deduction may be, one key question remains: what happens after 2028? Right now, this $6,000 senior deduction is only authorized for 4 years, ending in tax year 2028. That means unless Congress takes additional legislative action, this tax break will vanish by 2029, potentially increasing the tax burden for millions of seniors once again. The expiration date is baked into the reconciliation bill and reflects the usual budget limitations placed on temporary tax policies. If lawmakers don't revisit or renew the provision, the benefits will end just as quickly as they began. Whether or not the deduction is extended will depend heavily on future political dynamics. If there is strong public support, especially from seniors and retirement advocacy groups, Congress may feel pressured to make it permanent or replace it with a broader overhaul of how Social Security is taxed. On the flip side, lawmakers may also choose to let it expire due to concerns over lost revenue or budget constraints. There are already several proposals in Congress to repeal the taxation of Social Security benefits entirely, but none have advanced far. That's why it's so important to stay informed and involved. Your voice matters. If you think this deduction should be made permanent or expanded, contact your representatives and let them know. Given everything we've covered, it's a good time to start thinking about how you'll plan for the 2025 tax year and beyond. If you're already receiving Social Security, review your income sources and determine whether this deduction would significantly lower your taxable income. Are you close to the threshold where benefits start being taxed? If so, this could be a great opportunity to adjust your finances to maximize your benefit. If you're working with a tax advisor, be sure they're aware of this new deduction so they can factor it into your planning strategy. Even if you're not yet receiving Social Security, but you're close to retirement, this is the perfect time to prepare. Start looking at how your Social Security benefits, pensions, savings withdrawals, and other income sources will interact under this new deduction. Make sure to file your taxes properly in 2025 and beyond to take full advantage of the deduction, and consider how the expiration of the deduction in 2028 might affect your longer-term planning. Lastly, share this information with others, friends, neighbors, and relatives, especially those who may not be aware of the change. A few minutes of awareness today could mean hundreds or thousands of dollars in savings over the next 4 years. To recap, the White House has announced a $6,000 senior deduction set to begin in 2025, which may allow up to 88% of Social Security beneficiaries to avoid paying taxes on their benefits, for now. But this isn't a permanent change. It's a temporary policy, set to expire in 2028. And while it provides welcome relief, it's not a true repeal of Social Security taxation. The deduction is income limited, must be properly claimed, and will benefit some more than others depending on their financial situation. Still, it's an important development that deserves attention and planning. If you found this video helpful, please take a moment to like this video, subscribe to Social Security Post, and most importantly, leave a comment below with your thoughts or questions. Do you believe Social Security benefits should be taxed at all? And do you think temporary deductions like this are enough? Or should Congress go further and eliminate these taxes permanently? Your feedback helps guide future videos and supports others who may be navigating the same challenges. Thanks for watching, and we'll see you in the next video with more updates, news, and clear explanations about Social Security and retirement benefits. Until then, take care and stay informed.